Hello, this is Ken Tomko at T2 Asset Management doing our monthly review of what's going on in the markets. As always, please don't use these for trading purposes. They're for information only. Start here with the weekly chart of the S&P 500. This goes back to, it shows us last 5 years of trading here on S&P. Last couple of years, 25 and 26 started with a nice little decline to start the year, but both keep finishing higher. Mark just keeps wanting to drive higher and higher. As you can see here, a nice uptrend, and I put some support underneath us there at 7,200. We had a few weeks of back and forth here through early part of the summer and such, just kind of traded back and forth, and now it's busting out to new highs once again. So all systems go as we're looking at the longer term charts. Nothing to worry about as of yet, as um, we're moving on up. We go here to a daily chart. You see this will give us the last couple of years of trading, and here's the little sell-off that we had in March there to start this year. And then we've come up here again in the summer. You see on the daily chart, we just kind of went sideways. In the last video, I highlighted that we were in a triangle as it was kind of consolidating, and that suggested that we would break out higher. That did happen here. You see the nice breakout, and again, same thing on the daily chart here. We're just showing a market that's going up, up, up. Nothing to see that's concerning as of yet. Come down here to a little more detail. This is the 2-hour chart. This will give us about the last 6 months trading. We start to get in a little more detail, and you can see here's that sideways action that we had. But eventually, that's one of the ways the market consolidates. It's not just always go down. Sometimes it'll go sideways for a little bit before it wants to bust out higher, and that's what we're seeing. Let's take a look here at some of the internal measures in the market. First one here, this is the bullish percent of the S&P 500. This shows us the number of stocks in the S&P 500 that are, or the percentage of stocks, I should say, in the S&P 500 that are rising, and right now that's at 70%, which is a good number. Basically, a couple, 2/3 of the market is heading up. Sometimes we've seen rallies, as you can see here, through the May period is coming up, and that percentage was only 45% as it was getting driven just by a couple of bigger names coming up. This is starting to look a little more broad-based as we're up at 70%. If we look here, the next one down is the advanced decline line on the S&P 500, or I'm sorry, the New York Stock Exchange. And this gives us an idea of, it just gets a daily total of how many stocks advanced, a ratio of that to how many stocks decline. Again, that's heading up. That's all good sign. It looks like a nice healthy market there. And finally, at the bottom, we have the VIX, the volatility index, and that's the price that people are paying for insurance on their portfolios through put options. And that's down at 14, so really the lowest we've seen in months. So all of that suggests that this rally does have legs, and there's nothing wrong with it as of yet. Of course, markets can change their mind pretty quickly, but if you're just trying to read where it's going right now, the situation that we're in, it sure looks like all systems go. Come down here. This is just gives us a ratio of consumer discretionary stocks to consumer staple stocks. And in a rallying market, we expect this to be rising. It's not. They're going about sideways. So the consumer staple stocks are doing just as well as the consumer discretionary, which is a little bit defensive. But let's see, we come down here to the next one. Technology should be outperforming utilities. And it wasn't as we were going sideways, but now that seems to be busting back out, that the tech rally maybe is getting back started again. And that's what's led the market over the last couple of years here. Biotech relative to healthcare, I'd count that as sideways. Nothing to see there. And then hotels should be better than utilities in a rising economy. That's been about sideways too. So some of that data right there is a little sideways, but certainly not downward or anything like that. Let's look at interest rates here. This is the interest rate on a 10-year U.S. bond. I've highlighted in many videos past that for years here, we've just been sitting in this mid 4% range. Right now it's 4.63% is the interest rate on that. Certainly if we get a move out higher above that, that's going to be something that the stock market's going to react to. But otherwise, you can see here, we really just stayed put for years. So that's calming the market and allowing it to go higher. My biggest concern about the market, and I've said this in just every video that I've been um, doing, is the valuation. That this chart would show us what 20 times earnings, if the S&P were priced at 20 times earnings, which is a long-term good average for it to be at, we'd be at 46.81. We're we're nearly double that, right? We're approaching 8,000 here. So this market is way over its skis in terms of valuation. Now, the bottom line here that shows earnings. So earnings growth has been strong, and that's been, really good and helpful. So we haven't seen a recession. We haven't seen earnings going down, but boy, the market is just pricing it in. And that causes eventually a situation where, if you look at a longer term chart, you can see it is eventually going to reach that line at some point. It's not a timing indicator, but it's like a tree doesn't go to the sky, and either does the stock market. Eventually, it will find its valuation. The problem is it could be with the .com. People were screaming about the overvaluation during that period, but it took years for it to finally catch up. But just to know that the market is very, very expensive, and there could be a reckoning at some point. If we look here at economic indicators here, GDP growth rate, GDP annual growth rate, low twos. Those are good numbers. We're fine. Economy seems to be doing okay. Point of concern, the last payroll number here that we have was negative. We'll see how if that continues. You can get a bad month or something like that, and then have that fall off. But that's not really a good sign. You don't want to see a jobs number that's falling. But we can count it as a one-off for right now. We'll see at the next video what we're looking at. And then retail sales, they're still light. Last read 0.2%, but still not negative. So they are growing. That's a good thing to see. Inflation rate, we're mid threes. That's a good thing that we're not seeing it head off to 5-6%. Which would definitely get the market most likely moving in the negative direction. So anyway, for now, what we are is risk on, all systems go. The markets just keeps plumbing new highs, and as long as it does, we're going to keep invested with that, and just keep watching these charts to see when we're going to change direction. But nothing's happened as of yet. So hopefully that's helpful and informative. And if you have any questions, please let us know. I'm going to put up here our contact information. If you'd like to hear anything about what we're doing in our portfolios for our clients, please do reach out. Otherwise, again, thanks for watching, and we'll see you at the next update. Thanks so much.